Welcome to Safe Option Strategies presentation of the calendar spread. This class is a production of Safe Option Strategies and the content is protected by copyright. Any reproduction or redistribution of this or any Safe Option Strategies presentation is strictly prohibited by law. The information presented in this class is for education purposes only. Safe Option Strategy does not make any recommendations to buy or sell stocks or options. Trading stocks and options comes with risk, and you are solely responsible for any losses you may incur as a result of trading. So let's go ahead and define a calendar spread. As we're going through our debit spreads in this level of the program, we've talked about the bull call spread, we've talked about the bear put spread. And the thing that those two trades have in common, although one uses calls and one uses puts, the thing that they have in common is that the expiration date of our options are the same, whether we're using weekly options, monthly options, whether we're way out in time, whether we're a little closer in time to expiration dates, we're using the same expiration date for the long and the short option. That changes with a calendar spread. It's still a debit spread. There's still going to be money out. We are either going to use all calls or we're going to use all puts. There's going to be no mixing and matching in this particular trade. But a calendar spread could refer to a put spread or it could refer to a call spread. We'll talk in a minute about what I think is just the easiest way to differentiate when you're telling someone what kind of spread you're in. This takes advantage of a stagnant trend, and most stagnant trends are either slightly bullish or slightly bearish. There's certainly times when a stock gets into a real stagnant pattern and has a solid ceiling and a solid floor that it's testing as respectively as resistance and support. But oftentimes that mostly stagnant trend has a little bit of a bullish or a little bit of a bearish slant to it. We're going to buy to open this trade. The net result of the long options and the short options should be money out of our account to open the trade. That means when it comes time to close the trade, we're going to sell to close the overall trade, and that means there will be money in when we close the trade. The long option is typically placed at the money or very close to the money. It can be just in, it can be just out, and I put the word typically here. I'm going to say minimum, absolute minimum, 45 to 90 days out. Now you're going to find that more often than not in a calendar spread, you're going to be out towards the far end of this or even farther out in time with your long option. This is going to be your primary or your money-making option. The short option is placed at, above, or below the current stock price and is the secondary or hedging option. It could be at the same strike price as your long option. It could be at a higher strike price as your long option. It could be at a lower strike price than your long option. But this is our secondary or our hedging option. The cost basis or the net debit of the trade is, of course, whatever you spend on the long option minus what you bring in on the short option. The maximum risk is your cost basis. Now, with calendar spreads, calculating a maximum reward is easy if you're in a bull call calendar, which is a diagonal spread, or if you're in a bear put calendar, which is also a diagonal spread. It's not as easy to calculate a maximum reward if you're in a horizontal call calendar or if you're in a bear call calendar or a bull put calendar. I'll show you what I mean by that in just a moment. Good target return can be anywhere from 20 to 30%. It's not very often we're going to target more than 30% on return on this. And if we're going to be in this trade for less than 20%, it's probably not the best trade we could be in. Good target time in the trade is under 6 weeks. Notice the difference on this last bullet point from what we put for both the bull call class and the bear put class. In both of those instances, we said 2 to 3 weeks is ideal. We don't want to be in the trade any longer than 6 weeks. Under 6 weeks is nice on this one. It's not uncommon if we go a little bit greater than 6 weeks. Going a little bit past that is not a big deal. Does not automatically mean that we've made an adjustment to a trade. If we are in a bull call spread or a bear put spread, both of those are referred to as vertical debit spreads. If we're in either one of those trades and we're in the trade for more than 6 weeks, we've adjusted it. if we're in a calendar spread that's getting into a 7th or an 8th week, it might still be doing what we need to do, what we need it to do, and we just need to give it a little bit more time to get there. So it's not an automatic that we're adjusting the trade past 6 weeks. When we're calculating the risk to reward ratio, when we're trying to calculate our maximum risk and our maximum reward on this trade, remember that the max risk is the net debit of both options. Whatever the debit is we take on the long call minus whatever credit we take on the short call. If the price of the stock were to fall, now this is with, in the case of a call calendar, if the price of the stock were to fall and both options expired worthless, you could substitute the word if the price of the stock rises. I think that's grammatically correct. If the price of the stock rises, and you would be referring to the same thing with the put side. So if the stock is trending away from your options, in other words, the options are moving farther and farther out of the money instead of farther and farther in the money, they could eventually both become worthless and you could lose your maximum, you could lose the money you spent to be in the trade. Now, this is I'm going to talk about this throughout the presentation. It's kind of difficult to know exactly the right time when you're teaching someone a calendar spread for the very first time. It's a little bit tricky to know at what point do I talk about this concept of there being no maximum reward in a horizontal call calendar or in a bear call spread or bull put spread. I'm going to I need to talk about it a little bit. The net debit minus the difference in the strike prices if the stock moves high enough for us to get called out could also be a risk involved in the trade. Now, that's a clever way of saying whatever you pay to be in the trade, if your strike prices are the same, if you started with a 30 strike price long put and you had a 30 strike price short put, and the stock moved down so quickly, what's your obligation with a short put? I should put a P there for short put. What is your obligation with a short put? Someone has the ability to make you buy that stock. You are obligated to buy the stock at this price. If we had a 30 strike price short put and the stock is just dropping through that $30 strike price quickly, you have an obligation to buy that stock if the person who has the long put exercises it. If you had to buy the stock at 30 and your best protection is to sell it at 30 because this long put gives you the right to sell your stock at 30, that's great. There's no money lost right there on the transaction of having the stock put to you and being able to sell the stock. There's no money lost right there. It's a wash. But what if it still cost you $3.10 to be in that trade? As soon as these options have been exercised, you lose that $3.10 that you paid to be in that trade. That is a 100% loss. So in a calendar spread, whether a call calendar or a put calendar, if your strike prices are equal to each other, if you have the same strike price, even though you've got different expiration dates, you have a max risk, even if the stock moves in the direction more favorable to your long option. I'm going to talk more about that in just a moment. So I'm going to weave this thought process kind of in and out of the presentation in a couple of different places. So it's important to know when we're describing calendar spreads, there are 3 different setups for a calendar spread that all have the definition calendar. There are 3 different ways it can be set up with calls and 3 different ways it can be set up with puts, although they're kind of just a mirror of each other. In a situation where we are in different expiration dates but the same strike price, we would refer to this as a horizontal call calendar. Okay? It's a horizontal trade because when you draw these options on a chart, just like we've done right now, and you draw a line connecting them, it's a horizontal line. If the strike price of your short option is lower, whether you're using calls or puts, you would refer to this as a bear calendar spread. If you're using calls, you'd call it a bear call calendar. If you're using puts, you would call it a bear put calendar. to remember which it is, whether you're dealing with calls or puts, because remember, we're going to deal with one or we're going to deal with the other. We're not going to mix. We're either going to be using calls or we're going to be using puts. The easy way to remember it is draw the arrow from your long option to your short option, and if the arrow is moving down, what is a down market called? A bearish market, right? A down market is called a bearish market. So whether it's calls or puts, if the short option is at a lower strike price than your long option, you're in a bear calendar spread. You could call it a bear call calendar. You could call it a diagonal spread. Either one works. If the short option is at a higher strike price, you draw them on a chart, you draw the line connecting them. That line is moving upwards. That indicates a bullish move. You would call this a bull call calendar. And either of these two, a bull call calendar or a bear call calendar, either one of them can accurately be referred to as a diagonal call spread. That's an accurate term for either one of them. This could be called a horizontal call spread. Now, I'll reiterate this and re-emphasize it, or that's not, neither of those are exactly the right word. I'll restate this for repetition. I'll restate it with the puts, but let me teach you something that is going to help you with safe option strategies for the remainder of the time you're in this program, as you're looking at the trades we're doing, as you're listening to the chat sessions, excuse me, as we're doing live trading and so forth. This will help you a little bit. I'm not a big fan of the term diagonal call spread because it leaves a question in my mind. There's a question. If you told me you had a diagonal call spread on Under Armour, I would have to ask you the question, is it a bull call calendar or is it a bear call calendar? Because you have not completely identified the trade that you're in by just saying a diagonal call spread. You've gotten me partway there. You've helped me eliminate the horizontal spread, and I know you're not dealing with puts, but I'm still not certain whether you're in a bull call calendar or a bear call calendar if you just say diagonal spread. If you just say horizontal spread, I might be wondering, is he talking about calls or puts? Is she in a horizontal put spread, a horizontal call spread? These are the terms that I use, therefore I want you to learn these terms so that you're never in question as to the type of trade we're talking about. If I am in a diagonal call spread with my short call higher than my long call, I will always call that a bull call calendar. Because if I tell you or you tell me I am in a bull call calendar, there should be no doubt in your mind that you're not in a trade that's slanted this way, that you're not in a horizontal trade, and that you're not using puts. You don't need anything else to know the type of trade I'm in. Now, if we're talking about a particular trade, you want to know expiration dates and strike prices, that's fine. All that information's got to be provided no matter what trade you're talking about. But if I want you to know for certain the trade that I'm in, or I want to know for certain the trade you're in, I will always refer to this as a bear call calendar. I will never refer to it as a diagonal spread or even a diagonal call spread, because I'm still leaving you short on information. Now, everything applies the same when we're dealing with long puts and short puts. If they're at the same strike price, no matter what the expiration dates are, if they're at the same strike price, we are in a horizontal spread. If I just tell you a put calendar and there is not the word bull in that statement anywhere, and there is not the word bear in that statement anywhere, if I just tell you I'm in a put calendar, or you just tell me you're in a put calendar, I know we're talking about a horizontal spread because you didn't mention bull or bear. If it's a diagonal spread, you need to mention bull or bear. I need to tell you it's a bull spread or a bear spread. Okay, even though we've switched to puts, we're still in a bear put calendar if the short put is at a lower strike price than the long put. And we're still in a bull put calendar if the short put is at a higher strike price than the long put. If you were to draw these and connect from the long option to the short option, I know that's the opposite direction. Usually we're drawing our arrows this way because we're keeping track of time from here to here, not the other direction. So don't let that be confusing to you. Draw from the long option to the short option, and whatever slant that's on tells you if you're in a bull calendar or a bear calendar. It's fairly easy. Now, one other concept I want to be really clear on. This is our #1 rule when it comes to calendar spreads. Make sure you are correctly defining the spread you're in. I said one more thing to talk about. I'm thinking ahead. Rule #1, I'm thinking ahead already to rule #2. Rule #1, make sure you are correctly defining the spread that you're in. Any conversation you and I have in the future through emails, through instant messages, through phone conversations, if you have questions about a calendar spread, I want you to be in the habit of identifying correctly the type of spread you're in. Now, I'll demonstrate this with the long puts, and I'm not, or with the put calendars. I'm not going to back up to the call calendars to illustrate this point. I'll talk about it more in a minute. How do long puts gain value? What direction does the stock need to move for a long put to gain value? It has to move down, right? Okay, several of you answered, thank you. It has to move down. For a long put to gain value, it needs to be moving, the stock price needs to be moving down. If we switched all of these to calls, rather than go back to our other screen, what direction does the stock have to be moving for calls to go up in value? Now, when I say go up in value, I'm not talking about profit. When the stock is moving down and this long put is profiting, these short puts, any one of these short puts would be losing money, but that's because they're still going up in value. Make sure you're thinking about the difference. When we talk about going up in value, that is not automatically synonymous with profit. If you're in a short option that is going up in value, you're losing money because you could potentially have to buy it back for more than what you sold it for. So make sure you're always differentiating also whether we're talking about gaining value versus profiting. Long puts and short puts gain value when the stock price is moving down. Long calls and short calls gain value when the stock is moving up. That's good for the long calls, bad for the short calls. Now, one other thing I want to get you in the habit of, when you are looking at entering a calendar spread of any kind, do not start the calendar spread moving away from how your options gain value. Think about that for a minute. I could probably think of 2 or 3 or 4 other ways that I could state that, and I don't know that any one of them would be better than the other one. So listen carefully to what I'm saying. Do not start your calendar spread in the direction that is moving away from what your options would gain value. Let me tell you now what I mean by that. If long puts gain value when the stock price is moving down, don't start in a bullish direction. Once again, use your imagination for a minute. Pretend that all of these say respectively long and short call next to them instead of long and short put. If you're starting out a call calendar of some sort, do not start a call calendar that is a bear call calendar, where the trade is moving away from the direction that would cause the options to gain value. I'll try and make more sense of this as we show you a couple examples. Okay, we've got a stock chart open here of Valero. How do we know when the right time is to get into a calendar spread? Here we've got a stock that for 6 months it's been down, it's been up, it's been down, it's been up. It's tested some support and then it's broke through the support, and then it's gone up and tested a level of resistance, and then it's broken back down, and it's all over the place here. How do you know when it's time to do a calendar? Recently, it hit a low over this 6-month period of time and had a little bit of a bullish run. So why would we get into a calendar spread instead of something like a bull call spread that takes advantage of more of a robust run? Well, we've had this nice bullish run, but we came right back up to this level of resistance. You're going to look at and use levels of resistance and support as much or more with calendar spreads as any other trades that you ever use. Look for periods of time where the stock stays within that range, but stays maybe mostly bullish or stays mostly bearish. Now, this one I would say the bulls won right here. This one stayed a little more bullish than bearish during this stretch of time. History is never a guarantee to repeat itself, but sometimes it's the best thing we have to go on. Stocks tend to repeat what they've done in the past. The price movement of stocks has a tendency to do that. So if we've got a bullish move coming, but we feel it flattening a little bit, or if we've tested some levels of support, but each time we test it, the stock seems to come quickly back above, those are good times to get into a calendar spread. We want to see those time periods where it's been mostly flat, but oftentimes that mostly flat is going to have a little bit of direction to it. The number 2 rule for calendar spreads is if the most recent trend or overall trend is bullish, don't start that as a put calendar spread of any kind, even a bull put calendar. If the trend is somewhat bullish, use calls. I'll bet you can guess what rule number 3 is going to be when we get there. It'll be a minute before we get there, but I'll give you a hint. It's going to be almost identical to rule number 2. If the trend is bullish, even if only slightly, use calls for your calendar spread. So how do we structure the trade? We've got a stock that we feel is moving into or stuck in a pattern. We're looking at these levels of support and resistance. It seems to bounce off them. It might have a slight bullish trend to it, but mostly flat. And currently the price of the stock is at 67.78. We get our long call just out of the money. We go 60, 90, 120 days out in time. It's okay to be a little ways out in time on that long position. Get the long option out there a little ways. Give yourself time to work with this trade. Our short option is then placed maybe at the same strike price, maybe at a higher strike price. You're not going to start any type of a call calendar as a bear call calendar. Your opening trade will either be a horizontal call calendar or a diagonal bull call calendar. The only reason you should ever be in a bear call calendar is if you have adjusted your trade. It should never start that way. Okay? As the price of the stock moves up, both options are going to gain value. Remember, we're not talking about profit. We're talking both options are going to gain value. Good for the long calls, but bad for the short calls. And the easiest way to see profit in this trade is for the long calls to gain value faster than the short calls. But here's what's different about a calendar spread, because if we just stopped right there, if we put a period right here and we stopped and said, that's it, the long calls have to gain value faster than the short calls. That's incomplete. That's where you use a bull call spread. A calendar could also profit if the short calls lost a lot of value or maybe even expired without a substantial loss in the value of the long calls. So think about this. The stock is moving up a little bit in value, a little bit in price, not a lot. It's just a very tepid, very slow move. The whole month of August and half the month of September, it's barely getting from 67.78 to 71, maybe $71.50 a share. That amount of movement to the upside might be just enough to keep this from losing any money. Now, it could be losing time value. We might be losing some time decay in that long option, but we might be gaining a little bit of intrinsic value, and the two things could theoretically keep each other in check. So if this kept all of its value, if this did not go down at all, and this lost 100% of its value, couldn't we be profitable in the trade? What if we paid $3.75 for this option? Because we went way out here to December. $3.75 for this option. And for the option that expires next month, what if we took in a credit of $1.75? Our investment in this trade is $3.75 minus $1.75. We're invested $2 in this trade per share, right? However many shares we have, our net debit, our investment is $2 per share. If we get to the expiration date of this option right here, and it expires out of the money worthless, and this option has not lost a penny in value, maybe as the stock trickled around like this, it went down in value a little bit, it came up in value a little bit, it went down a little bit, it came back up. But when we get to the day that this option expires, this one is still trading at $3.75. What do? We sell it, right? We get out of the trade. If we spent $2 to get out of the trade, and that's money out to be in the trade, to be in the trade. If we spent $2, that's money out to get into this trade, and when we sell this option, it's $3.75 money in, and this is gone. This doesn't exist anymore. That's money in our pocket right there. Haven't we just profited $1.75 on a $2 per share trade that we could be in? Now this might make a little more sense of all this. What if the stock stayed kind of flat, didn't really have much of a bullish move, but it just sort of stayed flat? And let's go with the same numbers. We took in a credit of $175 right here. We paid out $3.75 right here. What if this expires worthless and this has lost $1 in value and is currently only worth $2.75? Have we profited, or are we losing money? What happens? We get to the day of expiration. We get to the third Friday of September. This thing expires. The stock never got above $72.50. If we paid $3.75 to get that long call, and we took in $1.75 to get this short call, our cost to be in the trade was $2 per share. We already established that. If we can sell to close this for $2.75, isn't that $2.75 money in? And if our net money out was $2, haven't we profited 75 cents a share now? And by the way, what is 75 cents divided by a $2 trade? 37.5%. See, even if the long option has lost some value, as long as the short option has lost more value than that, we can still get out of the trade with profit. So unlike the bull call spread or the bear put spread, we can get profit, excuse me, we can get profit if the stock is moving up a little bit, as long as the long call is going up in value faster than the short call. We may get out and get profit before we even get to the expiration date of this. Before we even get there, we might have profit just like we would in a bull call spread. Or we get to the day that this expires, and expires out of the money and worth nothing, and this still has enough value that we can close it and have profit overall in the trade. So either way would allow us to make money. Here's some real numbers. We buy to open the December 70 strike calls for a 236 debit. We sell to open the September 72.50 calls for a 37-cent per share credit. Our net debit, $1.99 per share. So how do we get profitable in this trade? This is our cost basis. How do we get profitable? Our maximum risk, if the stock fell, if the stock price fell and both options expired worthless, Our net debit is the same as our cost basis, same as our max risk. That's how much money we could lose, $1.99 per share. How could we make money on this trade? If in 54 days from now, we got to our September, from the day this screenshot was taken, obviously, we get to our September option expiration and the stock is trading at $72.39 a share. What's going to happen? What is going to happen at that point in time? This will be worthless and it will expire, correct? If this is at a 70 strike price and the stock is trading at 72.39, how much does this have to be worth? Even if there has been some time decay, and there will be, how much does it have to be worth as a bare minimum? At a bare minimum, it's got to be worth $2.39, right? At least. And probably still being out in December when we're in the month of September, and this still has until December before it expires. If it's $2.39 in the money, this thing might be worth $3 a share at that time. $2.80, $2.70. But we know it'll be worth at least $2.39. Well, if we spend $1.99 to get into this trade, and on the day these options expire, we can get out for $2.39, even just the intrinsic value. Haven't we just made 39 cents per share divided by $1.99? We just made 20% in the trade, 19.59%. I'm going to round that up to 20. 20%. Now, there's another thing that could happen. This is important to know with calendar spreads. And this becomes different. There's already a few things that are different. This is another thing that becomes different than the bull call spread or the bear put spread, which are the two trades you previously learned prior to this one. What if we're expecting this sort of slow, steady, stagnant trend? All of a sudden, the stock goes like that. And this is before the September options expire. All of a sudden, wham, that stock just skyrockets up. And now these 72.50 options, let's say it jumped up to $80 a share. And those 72.50 options, they're deep in the money now. And what's going to happen? What is our obligation with that short call? No matter what the trade we're in, no matter the strategy, we still have the same obligation with our short call. We have to sell someone some stock that we don't have. If we get called out, we've got to sell somebody some stock that we don't have. How are we going to get that stock? We don't want to go pay $80 a share for it. Oh, that's right. We can get it for $70 a share because we have that right. We paid this $2.36 for the right to buy this stock at that price. Make sense? So if we got called out at 72.50, but we have the right to buy at 70, we'll make $2.50 per share. But it cost us $1.99 to be in this whole trade to begin with. So we're going to make 51 cents. Now, this is a good thing when the difference between your strike prices is greater than what you paid to be in the trade. Now, I'm going to warn you right now, you cannot always find that in calendar spreads. That will not always be the case in a calendar spread. There will be times when all your due diligence says this is a good trade. This is a trade that I can be profitable in. And this will be 336, and this will be 37 cents. And your cost to be in the trade will be $2.99. And it might still make a lot of sense to be in the trade, but your strike price is less than what it cost you to be in the trade. That's if this were $2.99. Now what happens now if you get called out at 72.50? You get called out at 72.50. That's okay. You've got the right to buy at 70. Oh, but wait a minute. I only made $2.50 here, but I'm out $2.99. Suddenly that doesn't sound as appealing, does it? Now what's happened is I've got a 49 cent per share loss. let's not spell loose, let's spell loss. I've got a 49-cent per share loss now instead of a guaranteed profit. Anytime you are in a diagonal spread and you're only going to open a bull call calendar or a bear put calendar as a diagonal spread, anytime you're in a diagonal spread, make sure, try. Now you won't always be able to do this. I can't say make sure because that sounds too all-inclusive. Try, if possible, to get a situation where the difference in your strike prices is greater than what you pay to be in the trade, if at all possible. You might have a really good trade where that is not the case, but don't risk it. Don't take a chance if you can help it. Don't walk away from that trade if everything else about it looks good, but also you need to feel real strong about your level of resistance. So going back to that thought process we were just having, if I'm going to be at the 72.50 strike price with my short option and the 70 strike price with my long option, and this thing kind of gets that break above 70, the recent level of resistance is around 68.5 here. If it gets a break above 70, I better look back farther on this chart and see if there's a level of resistance that'll hold me below 72.50. That should be a 5. So if I'm going to take the chance on having the difference in my strike prices be less than what I'm paying to put in that trade, it might still be a good trade. I just want to really keep an eye on that level of resistance. This is in the bull call calendar. Now, in a horizontal call calendar where we use similar trade, but we use the same strike prices for both options, we can still profit the same way. This could lose all its value and this could maintain the majority of its value. Stock would have to stay right up there close to 70. So we could theoretically still profit that way. We could get to the expiration here, see this lose all of its value, and this maintain, excuse me, more than $1.40 that it cost us to be in the trade. So this could lose from 236 all the way down to 140, and we would still break even in the trade if this expired worthless. But the danger in doing a horizontal, and I'm not saying you should not do horizontal call calendars. The danger is that in this case, if the stock price skyrocketed up and you got called out at 70, and we talked about this earlier in the presentation, and you could exercise your right to buy at 70, that's great. That kept you from having a loss on the transaction of getting called out on the stock and being able to buy the stock, but you're out this money. My preference is bull call calendars over horizontal call calendars, but occasionally the circumstances are just right and a call calendar works out very well. Now, everything we just talked about works identical, but in the opposite direction when we're talking about put calendars. Everything's the same. The concepts are exactly the same. The only thing that's different is we've got a different direction. And even if it's only slightly bearish, if our most recent technical crossovers have been to the bearish side and we are ever so slightly bearish, we're not going to use calls to open a trade, a calendar spread. We're going to use puts to open a calendar spread. If the trend is bearish, even if only slightly, we're going to use puts. I'll go through this one kind of fast. The price of the stock is $80.12. Yeah, Joseph had a question. Would you ever sell more shorts before closing out the long? We are going to talk about that more in the adjustment class. So I'm going to save that for the adjustment, even though it technically might not be. It's kind of in a no man's land between maybe part of your original strategy versus part of your adjustment strategy. But we're going to talk a lot about that in the next class. So it's a good question. I don't mean to put off your question, but tune into the next class and we'll cover that in more detail. Current price of the stock, $80.12. We have an ever so slight bearish pattern. We place our long put at or maybe just out of the money. And then we get our short put. And we go maybe at the same strike price, maybe at a lower strike price. It's our secondary option or our hedging option. Price of the stock moves down. Both options gain value. It's good for the long puts, bad for the short puts. The long puts have to gain value faster than the short puts, or the short puts need to expire or lose value without as much of a loss in value of the long puts. So just like with the bull call calendar, if the stock is gradually moving down, the bear put calendar could profit if this expires worthless and this has held the majority of its value or more value than what the overall trade cost us to be in originally. Okay, January 80 strike long put, just barely out of the money when the stock's trading at 80.12. A September 75 short put. What is our obligation if the stock takes off to the downside? If the stock just begins to drop, and here's $75 a share, and it just drops and it goes right down to $65 a share. What is our obligation with that short put? We have to buy stock from someone, right? Someone is going to put their stock to us, and we have no choice. We have to buy it. But if we have to buy at 75 and turn around and sell at 80, that's a good deal. We're out whatever it cost us to be in the trade. But if we made $5 right here, minus 334, we've got a nice little profit in the trade. $1.66. $1.66 divided by 334, that would be a 49% profit on that trade. Fantastic if that happened. I'm going through the put stuff a little bit faster because there's nothing different in the concept of any of this. We're just moving it in a different direction and using puts instead of calls. Now, if I chose to get in with the same strike prices, now I've got that same potential dilemma. If the stock suddenly plummeted below $80 a share, if 80 was up here and in a blink of an eye, I'm down here at 70, someone's going to put stock to me at $80 a share. That's okay. I can sell it at 80 and not be stuck with a $70 a share stock that I paid $80 for. But I will be out the money that it cost me to be in this trade. In the very beginning of the class, one of the reasons we said in calendar spreads, there's not always a guaranteed profit, even when the stock may move in the direction that would favor your trade. Even if the stock moved in the direction that would favor your trade. You remember in one of the early classes when we talked about a lot of people say, and it's very cliche, stocks go up, stocks go down, and stocks go sideways. And we elaborated on that and we said stocks can go up really fast, they can go up at a moderate speed, they can go up really slow, they can be stagnant but with a lot of back and forth, they can go down really slow, they can go down at a moderate speed, they can go down really fast. When you're in a calendar spread, a horizontal calendar spread, this is the good direction and this, either of these is the wrong direction, either of these is the wrong direction, and either one could require an adjustment. Talk a lot more about that also in the next class. Let's review our rules. Make sure you're correctly defining the spread you're in. If the trend is bullish, even if only slightly, use calls. If the trend is bearish, even if only slightly, use puts. Now, we talked about this at the beginning. Now I'm going to share it with you as the fourth rule. Never open a diagonal calendar spread which starts in the opposite direction of the long option used. If you are using long puts, they profit, they go up in value when the stock is going down. Do not start your calendar spread in the other direction. Start it flat or start it in this direction, meaning you're going to use a horizontal put calendar or you're going to use a diagonal bear put calendar. You're going to open one of these two. You're never going to open the bull put calendar. Same thing with the calls. A long call gains value if the stock is moving up. We are not going to open the trade to the downside. Anytime you're using a diagonal spread, try to have a net profit available in case of the early assignment of your short option. We just spent time talking about that. That's what we were just talking about before we got to this screen, so I'm not going to reiterate that. Defining your exit strategy. Primary exit for any calendar spread is to see the short option lose value or expire worthless with little or no change in the value of the long option, or to see the long option increase in value faster than the short option. Target return should always be approximately the ROI that you can calculate by dividing the price of the short option by the price of the long option, and should never be set at 10% or lower. It should always be a minimum of 10% or higher. I would tell you most of the time try and get 20%. Being in the trade for 6 weeks or less is ideal, but that depends largely on how far out the short option is to expiration. Don't be worried or bothered if you're in a calendar spread into a 7th week or an 8th week. By nature, when we start these trades, we anticipate probably being in them a little bit longer. And in our next class, we will define and cover our adjustment strategies. When you have a stock that has an expectation for a slow to stagnant move, doesn't matter if it's bullish or bearish, a calendar spread of some type can take advantage, and it's a very flexible trade. When we get into the adjusting part of this trade, you're going to see why I like calendar spreads as much as I do. I'm a big fan of calendar spreads. They're so easy to adjust. The trade will work best after an earnings event has occurred and levels of support or resistance seem to really be holding strong. You don't want to be in a calendar spread through an earnings report, although of the first 3 debit spreads we teach, the bull call, the bear put, and calendar spreads, of those 3, the calendar spread is the one of those 3 that you can get away with being in through an earnings because of how easy it is to adjust. Not necessarily wanting to. Good target return, I'm going to change this and say 20 to 30%, and a good expectation of time spent. You can get out in them as early as 2 weeks. That's kind of rare. You're usually needing that 5-6 week stretch to get out of a calendar spread. Time decay in the short option can substantially help the success of the trade. Folks, that wraps up our calendar spread. Our next class is adjusting the calendar, and that's where you will find out why I love this trade. Thank you for your questions and comments. Everyone have a great day. Bye-bye.